Now, back by popular demand, it's the Lance Roberts Show.
And welcome to the show this morning. It's Tuesday as we get things underway. Of course, today is Technically Speaking Tuesday, which is where we release our Technically Speaking update on our website. So simply go by realinvestmentadvice.com, get the latest report that's out. If you're on our subscription list, if you have subscribed to our email list, we'll actually email that to you today. Of course, if you want to subscribe, we only send you two things a week. It's our newsletter on weekends and, of course, our Technically Speaking update on Tuesday, just to kind of let you know where markets are, what's going on, etc. Today's interesting because of two things that are going on. First of all, we are now in the beginning of May, which is typically the time of year where we begin to get the summer doldrums, and markets and economies and things like that tend to be a little bit weaker because we're taking time off for vacations and other things. So things tend to slow down a bit in the summer. And of course, with a market that's already had a terrific run, really ever since December the 24th lows, we've had this fantastic advance. This is now coming at a time where we're also now starting to talk about this resurgence of the trade war. And so really, rather than sell in May and go away, is the question really sell a trade war and go away, because that's really kind of where we are. Now, there's a difference this time, and here's what's really interesting. If we take a look back at the markets last year, as the markets were ramping up to highs, last year we were talking about this trade war, and we had written at the time that this was going to impact earnings and would basically wipe out most of the benefit for corporations received from tax cuts. And that actually turned out to be the case. By December, we completely wiped out all of the gains for the actual tax cut benefit that had come in from that reform. And so here we are now today, back at all-time highs. And of course, at the bottom of the markets last year, of course, this is where we started talking about, getting a trade deal done. We're going to get this done. The Federal Reserve kind of backing off their actions as well under pressure from the White House. The markets rallied on that. The difference this time is that while President Trump is in a much better position, we talked about this yesterday, Trump's in a much better position now because he's back to where he was last September. So this gives him a little bit more breathing room to play kind of hard line with China versus where we were in December. Had the markets been down 20% now, and we were back where we were in December, trying to play hard line with China becomes much more difficult. With markets back to all-time highs, this makes it much easier to play a little bit tougher baseball, of course, with China. And China's got some risk here as well. Now, there's a difference between the two countries, though, is that China has the ability to do a tremendous amount of government stimulus to offset weakness. Plus, they really don't care about their people as much as we do. So the benefit for China longer term is to work on a trade deal that doesn't impact their ability to operate really kind of as a state-run economy. Some of the requirements being suggested under this trade agreement would actually suggest that China actually changes their laws in many cases, and they want the tariffs removed. The U.S. wants to keep tariffs on the plate here to use it as an enforcement tool. So these are some major sticking points in this trade negotiation. So to have it expected to wrap up here very quickly may be a little bit optimistic. But more importantly here, the markets have had this fantastic run. We're moving into summer. We've now got this trade war restarting. So to expect that this market will not correct sometime this summer is probably just a little bit naive, given the fact that in every single year, markets do correct to some degree. Between 5 and 10% every single year, you typically get that. So expecting some type of correction this summer would be very likely. Could that process be starting now? Absolutely. We've had this very strong advance here. We're now beginning to violate that upline, that uptrend that we've had since the December the 24th lows. So an expectation for some type of retest of support, probably around the 200-day moving average, would be very likely. Now, that's not a huge drawdown. That's only about 3% from here. It's not a big deal. But more importantly is that would also give you a better opportunity to put more money to work. Rather than chasing markets here at all-time or near all-time highs, it would be better to wait for a better opportunity to put some money to work. And it also give you a much better return on investment. So, and this is why last week, in last weekend's newsletter, it's on the website now under the newsletter tab, we talked about ringing the cash register. Last Tuesday, we took some positions off the tables, raised a little bit of cash. Nothing major, just kind of trimmed trimmed around the edges, reshored up some of our equity positions, added to healthcare, which was a big beneficiary yesterday because it's a good defensive sector and it's already been under a lot of pressure recently, so there was some value there. Market saw that yesterday, used that kind of as a defensive position. Fixed income continues to do well here because, well, it's also a risk-off position. So when there's concerns about the markets and what's happening as we are seeing currently, money tends to flow into areas that will have a little bit more safety to them. So fixed income and cash tend to be those opportunities. So continue to look at those areas of the markets as well, because these are the areas that tend to hold up better if we're going to have some volatility this summer. Now, I want to be clear here because a lot of people assume that as soon as you talk about taking profits or taking some action, that means sell everything into cash and run away. No, look, portfolio management's a function of kind of trimming around the edges, making small movements. Small movements tend to provide better rates of return over time and also helps avoid your risk. You know, the biggest problem that investors have typically is that they wind up giving too much of their gains back. And this spends a lot of time, as we've looked at this, period of time, just even over the last year and a half. Here we are, heading towards June. Over the last year and a half, the markets really have gone nowhere. So for most investors, they're about where they were last January. And this is kind of the function of when you give up a lot of gains in the markets and you wind up just getting them back, you really don't wind up making a huge amount of return. Now, over time, this will turn out to be just a blip in the radar, but it's important that we survive these periods. You know, a lot of people were selling their portfolios out in December of last year. They're just now starting to get back in the market. This is the epitome of the sell low, buy high syndrome, which is exactly the opposite of how we want to approach portfolio management and markets. And when we have a lot of things happening economically, look, we're very late in an economic cycle. We are now actually just this next month, we'll have the longest economic expansion on record. Pretty fantastic, right? Well, it's also the fact that records are records for a reason. We've got ultra low unemployment. We've got very low jobless claims. Those are hallmarks of late stage economic cycles. Remember that recessions aren't born out of things being really terrible. That's where expansions are born from. Recessions are born from peak optimism, peak employment, peak jobless claims, because you've got everything done. So the only opposite of that is to reduce those excesses where you pull those back. Quick break. We'll come back after the break. I'm your host, Lance Roberts, for today's edition of the Lance Roberts Show right here at realinvestmentadvice.com.
Catch Lance Roberts' podcast later at lancerobertsshow.com.